Hello and welcome to Indianomics. Indian households are seeing their savings dwindle and debt burden rise. That's according to the latest Reserve Bank of India report. It says household savings in FY23, the just ended financial year, has declined to the lowest level in 47 years to 5.1%. At the same time, household liabilities are rising. That is, household borrowing is at the second highest level since independence at 5.8% of GDP. So what does this mean for the economy? If net savings, household savings are going to dwindle so much, who finances the fiscal deficit? And is there a problem with the households themselves in terms of unsustainable debt? To answer these and other questions, I have with me an elite panel of economists. I have with me Nikhil Gupta, the chief economist at Motilal Oswal Financial Services, whose recent book, The 8% Economy, discusses exactly this, the household incomes and their lack of savings. Abhishek Upadhyay, the senior economist at ICICI Securities Primary Dealership, has also written on this point, and Rathin, Managing Director, Overseas Development Institute, a veteran observer of the Indian economy. Gentlemen, thank you very much for your time. Nikhil, to you first. Since you have, analyzed this at length in your book, this latest number kind of vindicates your worry. You think that we are at some perilous level of household savings falling?
Hi, Lata. Yes, so the fall in financial savings to 5.1% is definitely shocking to even me. We were expecting close to 6%, which in itself would have been a 3-decade low number. But 5.1% is even worse than what we were expecting. Now, what it means is we know that inflation was very high in FY22, FY23. And one of the questions that was on everybody's mind was, despite higher inflation, why is consumption not being affected? And now we know the reason. It was not the consumption which got affected. In fact, consumption growth was maintained last year, but most of the burden was taken by financial services, which, as you just mentioned, has fallen to 47-year low in FY23. While I'll also mention on household borrowings that you talked about, the key reason why household net financial savings have fallen to 5% is because household borrowings were at 5.8% of GDP in FY23, which is compared to just 4% in the previous few years and the second highest in almost the last 70 years. Now, what it means is that individuals are borrowing more to finance their investments, could be their housing purchases, or to finance their consumption. Now, when we look at household debt, we know that out of total debt of almost 37.5% in FY23, only about 1/3 of that debt is on account of housing. The remaining 2/3 of debt is on account of consumption. And we know that over the last few years, on an average, or in FY23 as well, the non-housing debt has increased at a faster pace than housing debt for the entire household sector. So the fact that households are maintaining their consumption, there is no doubt higher consumption is maintaining GDP growth. It is supporting GDP growth. When households borrow and invest in real estate, it is supporting GDP growth. But at the same time, it is happening at the cost of financial savings. It is happening at the cost of higher debt of the household sector, which is more and more moving towards the non-housing sector. So the sustainability of this kind of growth is definitely a question. So even if it is good in the short term, from a medium to long term perspective, it is definitely a concern.
Okay. I want to understand the macro implications for growth, but I will come to that in the next round. Abhishek, the immediate worry is that if people are running down their savings, households, then are we going to reach or hit another cycle of NPAs? Is that the immediate worry?
Well, so first, Lata, I agree with what Nikhil said, that this sharp increase in household liabilities raises question mark about the sustainability of private consumption as a driver of growth as we look into the latter part of this fiscal and next year, when we know exports are going to weaken. Also, in this period, there are doubts about private capex recovery, whether it will recover in the next few months. In our view, it will still take some time for private capex to recover. So clearly, headwinds to consumption raise some worries about the growth outlook. I do agree, however, that these variables you look more from a medium term standpoint rather than from a near term perspective. It is possible that the household debt levels that we have currently are still not close to that threshold level of debt where households really start to curb their demand. And we know studies such as from institutions like BIS have indicated that this threshold is close to 60% of GDP. It will vary across countries, could be lower for India, but still it is possible. We are not at levels where maybe immediately there is big reason to worry. What gives me some comfort here is though that despite the net financial assets for households coming down so low, overall CAD to GDP was still 2% last year. So that is well within bounds which you consider sustainable, and from a national balance sheet perspective, still not worrying. But on your question about bank NPAs, I think what is a relief here is that a lot of this flow is coming from banks rather than from NBFCs that we saw post demonetization, which ultimately culminated into NBFC crisis, and that had a knock-on effect on private consumption.
Okay.
At this stage, I will not worry given bank balance sheets, but yeah, from medium-term perspective, could be a concern.
Okay, no, it's good that you said that current account deficit has not risen, because I do want to get to the macro picture, but I'll just settle the micro picture first before I toss the macro to Rathin. Nikhil, is there a worry in the micro picture in terms of households borrowing too much? See, ours is actually, in terms of cross-country comparisons, under-leveraged households. Foreign households are much more leveraged. But when you rise so suddenly, part of it can be digitization, and to some extent, Abhishek seems to have, is hinting at that because there are better digital products, maybe microfinance companies that are able to lend better, banks are able to lend better to households. But it's risen suddenly. So do you think there is a more micro financial instability problem with respect to over-lending to over-indebted households?
So, Lata, there is no way we can answer that question because there is absolutely almost no data to understand the profile of these borrowers. We don't know their income profile. We don't know what kind of wealth they hold. And even when we look at the breakup of banks' personal loans, which is a part of household sector, we know that almost 1/3 of the increase in personal loans in the past 1 year has been on the account of something called others. Now, that others could include a host of factors. But my understanding is, yes, it is very sudden. Yes, it is a sharp rise, but it may not immediately lead to a concern on NPAs as you are highlighting. I still believe if that has to happen, probably it may take some more time to happen. But again, it is very difficult to answer that question because we do not have any details as to the profile of these borrowers. We don't know if these borrowers are new borrowers, if the same borrowers are borrowing more. Very difficult to answer this question.
No, I take your point, and I shouldn't overstate by saying NPAs, especially at a time when bank balance sheets are actually looking very good. So maybe it is fintechs, maybe it is P2P lending, maybe it's other kinds of lending which is not at all connected with the stocks that are reporting their numbers. So I don't want to give that fear. I'm just wondering if there is over-lending at some point in some quarters. But now, Rathin, I want you to comment on the micro, but more importantly, the macro question that Abhishek alluded to. If net household savings is only 5.1% that is available for others to borrow, and fiscal deficit is running at 9% in the latest year, are we in some kind of an unsustainability over here?
Well, let me first comment on the NPA issue. NPAs in India don't happen because of poor people. NPAs happen because of rich people, like Subhash Chandra Z and Nirav Modi and people like that. So if these poor households are borrowing and they default, I don't think that the cost to banks is going to be that large because they're not too big enough to fail. So their collateral will be secured, and they might commit suicide, but their collateral will be secured, and on the NPA side, it's fine. On the macro side, look at it in the following way. So what is the action now? We're a developing country, presumably, even Mr. Modi. If we are, then we are well below our potential peak level economic performance. We have not reached peak.
Yes.
Those circumstances, to reach peak India, the country has to invest. That investment can come from foreign direct investment and foreign portfolio investment. But most important, it comes from domestic savings. Government is not saving. Now we discover that households in the net are not saving, right?
Yeah.
Because the total amount of household debt as a percentage of GDP is now exceeding the total amount of savings. And the only consistent saver as such appears to be the non-financial corporate sector. And we know what they do with their money. They go debt-free. They're not investing,
Yeah.
right? And that's been happening since COVID.
Yes.
So what you're getting is a classic low-level equilibrium trap in macro terms.
Okay.
The government will be able to borrow simply because it has preemptive access to total savings. It is able to persuade foreign investors yet to come in and, take on rupee debt. And there is scope at the margin for them to do so. And government security is a reasonable safe bet for a private sector that's not interested in doing anything with the savings it has. So I don't anticipate any kind of funding crisis happening to government, except that, for the best will in the world, the revenue deficit being more than half of the total deficit, government also is borrowing to consume. So households are borrowing to consume, governments are borrowing to consume. The private sector is not investing, it's saving instead. That is not a very healthy state of affairs for an aspirationally growing economy, which has already moderated its expectations, I note, from 8% to 7% to 6% of GDP in terms of growth rate. So I think that is the overall situation. I want to make one final comment on consumption borrowing. Unfortunately, there are good and bad kinds of borrowing for investment, there are good and bad kinds of borrowing for consumption. One of the very bad signs of borrowing for consumption is when you borrow to sort of counter life cycle volatility. And that happens when you borrow for healthcare. We know that those numbers are going up quite significantly. Another number, which is small still in the aggregate, but has gone up quite significantly for relatively high net worth households, is borrowing for education. Quite commonplace now that unless you're a very wealthy family, even if your child goes to a domestic MBA type institution, you have to borrow to finance the education. So that is a pile of debt that has macroeconomic implications going forward, which I would worry about. And the low household savings rate also reflects this sort of new kinds of borrowing that are happening as households seek to cope with an increasingly tight job market, lack of opportunities, et cetera, plus volatility caused by an increasingly expensive and broken healthcare system.
Okay. Now, these are some serious conclusions that our experts are drawing. I would want the others also to comment on these macro implications or deductions that we may make from this data that Rathin Roy is pointing to, that if households are slaving at a lower pace, government is just saving, corporate sector is not investing, then are we likely to get trapped in a slightly lower rate of growth than our aspirational 8%? All those questions after the break. Bear with me, gentlemen. I'm back in a jiffy. Welcome back. The Reserve Bank released data which has caused a bit of a stir. Household savings, net savings as a percentage of GDP is at a 47-year low of 5.1%. Even gross savings are lower at 10.9, but that's more like perhaps a 6-year or a 10-year low. And household liabilities have gone up, and that's about a 2-decade high. So are we in a kind of a problem, micro problem of too much indebtedness, and a macro problem of will we be able to finance our growth aspirations? I've been speaking with Nikhil Gupta of Motilal Oswal, Abhishek Upadhyay of ICICI Primary Dealership Unit, and Rathin Roy of Overseas Development Institute. Gentlemen, thank you for your patience. Nikhil, before going to break, Rathin raised the issue that if households are saving less, much less than they did a few years ago, and government is just saving, corporate sector not really investing much, are we in a low growth trap? I mean, who will finance the growth? Do you think that this is a big macro question?
Yes, Lata, that has been at the core of the entire situation or the analysis that we have done in the past few years. What we need to understand is that at this point in time, there is no risk as Dr. Roy mentioned, there is no risk as to the funding of the government fiscal deficit, primarily because the corporate sector is not investing. And that is why the more profits that we have, the more surplus the corporate sector is having, which is in turn funding the fiscal deficit, despite the fact that household financial savings have gone down. If the corporate sector decides tomorrow to invest, if that happens, then there are only two possible situations. One, either the government will have to reduce their fiscal deficit, which is not going to be an easy thing, or the current account deficit will widen. There is no other way. With lower household savings, we are able to fund government fiscal deficit at this point only because of corporate investment is weak at the same time when corporate profits or surplus is high. That is one. Secondly, I want to mention about this entire connection between household borrowings and household savings. See, one of the facts that I've been hearing is it is okay if the household net financial savings are lower, because it is not because gross financial savings have come off, it is because households have borrowed more. And households borrow to invest or to consume. So they are spending, which is a good thing. They are supporting GDP growth. There should not be a concern. Now, the concern is not in the immediate term. It is not in the short term. But please understand, if households continue to borrow and their debt continues to rise, then as we progress into the years, households will be spending a larger and larger share of their income to service those debts, which means that I will have a smaller portion of income, which is truly disposable income, by which I mean the proportion of income available to consume and save will continue to fall as the ratio of debt servicing keeps going up with rising debt to income ratio. Now, logically speaking, we are an aspirational economy, we are a young economy, so my consumption growth is something considered structural, that my consumption growth will remain at 7%. If that is the case, then we are saying there is a structural case that savings will remain low. And if that is the case, then we fall into that trap, that is household savings continue to remain low. What will fund government fiscal deficit if corporate sector decides tomorrow to invest?
Okay.
Because that is possible only and only through higher CAD, which is very recent in our memories. Okay. What higher CAD can do, we have seen during FY10 to 13. So I don't think any one of us want to see a repeat of that.
No, we don't want that. One only hopes that private sector finds the reason to invest if households are showing the proclivity to consume that they are. Abhishek, your macro observations, you spoke about the current account deficit already likely to rise if we continue with low savings and high government borrowing. But just a broader question, I haven't been able to put this data on air, but our savings rate in 2000, 2001 was as low as 25%, 26%. And then we rise all the way to 36%, 38% in the 2008-2012 period. And now it is back at 30%. So overall savings also is indicating that we will not be able to finance higher growth, is it? Is that what we should take away from this savings peaking off rather decisively?
Well, there are various issues there. One is, when you're looking at household savings, there are two parts. The net financial assets, as we have been discussing, and the other is the physical savings, investment in real estate, etc. So what we had in the last decade is, real estate cycle was down, and therefore household physical savings also went down. And that was also a factor which was weighing down on overall gross savings. What we have seen of late, and one reason why net financial assets number was so low and liability number was so high was because a lot of mortgage loans, etc., are taking place now as real estate cycle, trends higher again. So that is one mitigating factor that maybe we are still in the early stages of this, and there is still nothing to suggest that we have a real estate bubble which can create financial stability issue, right? But the broader issue really is, and which was discussed, whether government can bring down fiscal deficit quickly as private capex recovery starts to happen, and that is going to be the critical issue that we need to discuss more. Only reprieve here is that if you're looking at government fiscal deficit, if you're compared to pre-COVID years, there has been a substantial increase in infrastructure investment and capex part of
Yes.
spending, which is a relief.
That's
But overall fiscal deficit still needs to come down
and
reasonably quickly as capex starts to happen.
okay. Rathin, actually running at the last 1 minute of the discussion, what would your final observations be? Do you think that government's fiscal transfers, at least during the COVID years, were to prop up consumption in a helpless situation? And to be fair, the central government capex itself has been healthy. So, while fiscal deficit is high, it is kind of geared towards growth from its capex element. So things are not as bleak if the government is holding the capex baby till the corporate sector takes it from them.
Well, two quick points. One, Nikhil Gupta has shown quite nicely that actually that's not true.
Oh.
The increase in on-budget capex has been almost entirely matched by a decrease in public sector capex. So that basically what you're seeing there is a reshuffling of capex within the public sector balance sheet. Second, capex in India, very famously, depends on when it is complete. You're all from Bombay. I mean, where is this Bombay airport? I've been hearing about it since I was 15 years old. So, given the time delays and cost overruns in capex, the impact of capex on growth actually comes when you actually complete and finish a capex project, and that's not happening. Third, the import content of a lot of the capex we do in the road sector, in the transport sector is very, very high. Those 800, 190 planes they're going to buy from the USA, which Biden is very happy about, that's capex, but that's all imported. So the economic impact of that is minor. The second point I want to make is related, which is this points to one more thing. This suit boot Indian growth story is over. You're talking about mortgages. Who takes mortgages in India? A very small segment of the population. So what is happening now is that to a large extent, the macro numbers that the Indian economy reflects continue to be based on the consumption and investment behavior of a very small part of the population. We have not been able to broad base it. Even people taking 3 to 4x the minimum wage don't go to the market, take EMIs and build houses in tier 2, tier 3 cities. People talk about it, but it isn't happening in any significant measure. So until we're able to broad base our growth process, I think what this shows us is what is classically called a low-level equilibrium trap, which is to basically be in a situation where there is nothing more to invest on because there's no incremental market. The capital stock you have is enough to finance aggregate consumption now. There's some cross-switching of consumption between sectors. You chug along at 5 to 6%, but your growth story is over because you could not broad base it. I think this is yet another signal.
Yeah.
This is
I remember the piece you wrote about this about 5-6 years ago on how even the 1991 broad basing of consumption was only broad basing it from probably 5% to 15%, but it is still a very narrow class that you can describe as the formal economy. This was an extremely rich discussion. Some initial worries on how are we going to finance macro growth and broad basing of Indian consumption is clearly coming out from these numbers. But let's not run away that there is a problem of unsecured debt or NPAs. Perhaps this divergence between growing liabilities and falling savings will get corrected. Let's hope it's only a result of the COVID period. This discussion will be on. Thank you very much for kick-starting this discussion on a high note. Nikhil Gupta, Abhishek and Rathin Roy, thank you very much for joining.